All right, everyone, let's continue with the issue of personal tax income. So, what we discussed before about corporate tax income left out the fact that, well, whatever individual people make in terms of income would also be a target of taxation from the government, right? So, in essence, when we say, well, if you pay dividends, the corporation is going to be taxed, but if you pay interest, the corporation won't be taxed. It basically is saying, okay, part of the firm value is going to be taken away by the government, and you can shrink that part by levering the firm. All right. However, once you shrink that part, well, basically equity part, in essence, you're saying that, well, I'm giving equity to real people. Now, those real people are going to have higher incomes, and their incomes are going to be taxed. So this is basically relevant for the notion of equity holders' wealth. So what we showed before was like equity holders' wealth would be less impacted by taxation due to that tax asymmetry that would treat debt interest differently than equity. But the equity holder's wealth itself is subject to income tax, right? Personal income tax. And then now we're going to show that, well, once you have personal income tax, the story is going to be different. So, in essence, whatever payments a person receives from a corporation in terms of interest or dividend income, it's going to be subject to some sort of tax, right? Now, the capital gains, however, are going to be taxed only if the shares are sold. Okay, in particular, if it's in form of like change in the value of equity. Which means that the capital gains could be postponed by not selling shares, or capital losses could be deducted immediately by realizing the gain. And this is actually giving rise to something very famous in finance literature called as January effect or the December effect, where people sell loser stocks in December and buy them back in January. So basically, they want to say, well, I really lost a lot of value, so I'm going to sell whatever I lost value on to realize the tax deductions, right, this year, and then buy them back again next year. Well, but that's not the issue here. But the problem is this tax timing is going to matter, and then the fact that there is personal tax is going to matter. Anyway, the capital gains tax timing is going to lower the effective tax rate on shareholders' income, and then that's what we're interested in here. So the idea is there's the differentials between tax rates on personal income and debt income, right? And what's going to happen is that equity cancels out the effect of corporate tax asymmetry, right? So in essence, we're basically going to come up with an assumption that under certain conditions, the personal tax existence of personal income tax is going to basically make the capital structure irrelevant again, which is basically a cool conclusion. However, it's not a general conclusion. There has to be certain conditions satisfied in order for this conclusions to be drawn. All right, let's go back to our example of MFI. We have an annual cash flow of $300 per year. The corporate tax income rate is 40%, and shareholders pay 10% income tax on their equity income. So this is the additional assumption that we have. Okay, so beforehand we didn't have any personal income. Now we have a 10% personal income on equity income. Okay, well now we're going to compute the MFI firm value in the all equity form, of course. And what we have here is like, okay, I $180 of after tax cash flows if this is all equity, right? Because there's 300, and then 40% of that is taken away by the government. So then whatever remains off of this at 300 is going to be also taxed at a 10% rate, and that's the personal tax, right? So the after tax, like after whatever tax there is, cash flow from the equity holder's perspective is going to be only $162. And then if you use the 15% required of return, which we used at the very beginning, we have a 180 sorry $1,080 of equity value, right? Okay, so let's keep in mind this 180. We're going to get back to this later. Now suppose that MFI issues $540 of debt. Okay, so we're not doing 1,000 anymore. There's a reason for that. We'll see that soon. Debt holders require 10% rate of return after personal taxes. So basically, they want $54 net of everything. So that's what they require. Okay, so that's important. The debt holders face an income tax rate of 46%. So notice the tax asymmetry. The income tax on debt interest is higher than equity. So this is basically telling that, okay, these people did not pay tax when they took out money. These people, I mean, referring to equity holders, did not pay tax when they took money out of the corporation in form of cash. Now, their personal tax is going to be taxed at a lower rate, okay, so that it's going to cancel out the effect of tax credits on interest payments. So basically, we have like opposing effects here. Tax rates for personal income off of debt is higher than the tax rate for personal income off of equity, okay, because they are treated in opposing ways within the firm, right? Okay, so we'll see that in detail soon. Now let's compute the MFI's equity, total firm value, shareholders' wealth after this capital structure change. All right, so debt holders want a 10%, which means that they want $54 after all the types of taxes, all right? And that means that before tax, they want a $100 payment. So only a $100 interest payment before tax is able to make a $54 after tax payment if tax rate is 46%. The personal tax rate is 46%. Okay, that's good. So the after corporate tax cash flow to shareholders now would be what? Would be the $100 that is taken away to be given to debt holders before personal debt interest tax, which is 46%, which gives rise to $54 of after tax payments to debt holders. So this is deducted from 300, so $200 of before tax to equity holders. Now 40% equity holder, 40% of corporate tax is going to reduce the after corporate tax cash flow to 120. But this is before the personal tax on equity income, which is 10%. So if we apply that one as well, we end up with a $108 of after tax, after corporate and personal tax cash flow to equity holders. Right? In this case, we're going to use the 20% required rate of return. Okay, we're going to see why this is later and how this is very similar to our original situation. And we're going to end up with a $540 of equity value. Right? Now, add to that the $540 of debt value to get $1,080. Is this number familiar? I'm sure it is. So if we go back here, ta-da! So the before any change in financial structure, the total firm value used to be $1,080. Now again, after the financial structure change is $1,080. So it basically says that the change in this financial structure did not really impact the firm value. And the reason is the asymmetric taxes that are now favoring equity holders instead of debt holders. Total value of the firm, $1,080 as a result, and this is how we break down the magnitudes here. So again, we have a total pie, this pie of $2,000 value. Now, before doing leverage, before levering the firm, equity holders would take away $1,080 off of this. Then the rest of the pie would be collected by the government. $120 in form of personal tax off of equity holders and $800 of corporate tax. So in essence, if you consider this component, we are back to the corporate tax view, right? 120 plus 1,080, 1,200. That's exactly what we had in the absence of personal tax. So this tells you why I'm picking these numbers. I just want to make sure that the numbers are correct. Now, when we do the leverage, we lever the firm with the personal tax income on both debt and equity, we have a very different result. So what's going to happen is that the debt and equity is going to break into two equal values, 540, 540. Now, a lot of tax on debt holders is going to be collected here. So the government says, okay, I'm not taxing the corporation for raising debt, but I have to tax whoever make that debt interest, and those people are the debt holders. So that's why you have this huge a tax being deducted off of debt value, and then equity tax rate is now $60. Well, obviously the value has gone from 180 to 540, going down by 50%, which means that the equity personal tax should be halved as well. So it's going from 120 to 60 down here, which is clear. And then the corporate tax is $400. So again, if we basically set aside this portion of the pie, right, this remaining portion could be seen as a sum of debt and equity value in the case where we did not have personal tax. Remember, $1,600 was the total value of the firm, and all these together, right, this part here is actually $1,600. So this is, this part here is 1,600, and that's exactly what we had before. Okay, all right. So moving on, with corporate and personal tax rate, the firm value and shareholder wealth is independent of firm's capital structure again under certain circumstance, and that circumstance is given by this formula. Only when 1 minus tax rate on debt income, personal tax rate on debt income, is equal to 1 minus personal tax on equity, rate of personal tax on equity, times 1 minus corporate tax. If this equality holds, then the capital structure is again irrelevant. And for our example, we exactly have that result. So if you actually do this calculation, you end up saying that it's exactly 0.54. All right, we'll try it later. So this is basically concluding what I wanted to have for our lecture today. Next time we're going to look at the agency view and incorporate everything, integrate everything that we had together into one unifying platform, which gives us a pretty cool idea about how capital structure would matter, why it would matter, and how firms should go about selecting the optimal capital structure. All right, this was great. So let's see you next week. And by the way, I will release some assignments soon. All right.